Which institutional LP is right for your real estate development, a family office, or a private equity fund? The right LP depends on 4 variables: required check size, timeline flexibility, return expectations, and how much institutional governance your firm can absorb. According to the Goldman Sachs 2025 Family Office Investment Insights Report, 44% of family offices now invest primarily in private real estate, and U.S. family office real estate allocations rose from 10 to 18% between 2023 and 2024. Capital is available from both LP types. The question is fit, not quality. What do family offices actually screen for before committing to a real estate deal? Family offices screen for 6 things: a track record with realized exits, downside protection before upside, capital preservation alignment, deal-by-deal structures over blind pool commitments, a warm introduction from a credible intermediary, and governance transparency, including clean waterfall mechanics and defined reporting. According to the PwC Global Family Office Deals Study 2025, direct and co-investment strategies now represent the majority of how family capital enters private markets. A developer with 3 or more completed projects and documented returns carries far more weight than a compelling pipeline narrative. What do private equity funds pressure test before committing to a real estate deal? PE funds pressure test 6 things: return profile and IRR underwriting against a 15 to 25% target, a defined hold period and exit strategy that fits within the fund's life cycle, formal quarterly reporting and governance capacity, sponsor creditworthiness and co-investment, mandate fit by asset class and market, and scalability signals across multiple projects. If your deal does not support the fund's required IRR at their entry terms, it will not clear the investment committee regardless of the relationship. How do family offices and private equity funds compare across the 8 factors that determine LP fit? Family offices write checks of $5 million to $25 million, move faster with 1 or 2 decision makers, or carry lower governance burden, target 7 to 12% returns, and hold assets indefinitely. PE funds write checks of $10 million to $100 million or more, require an investment committee process, impose formal quarterly reporting, target 15 to 25% IRR, and enforce exit timelines tied to the fund's lifecycle. The sharpest difference is return expectations. A lower return hurdle from a family office typically means better GP promote economics. Are family offices or PE funds better for ground-up development? Family offices are better suited for ground-up development because their patient capital model accommodates longer holds, staged capital calls tied to construction milestones, and timeline variability without fund cycle pressure. PE funds can work for ground-up development only when entitlement risk is already resolved and the construction to exit timeline fits cleanly within the fund's life cycle. If your deal has entitlement risk, construction variability, or lease-up uncertainty, a family office is the more forgiving partner. Which asset classes attract the strongest institutional LP interest in 2026? Multifamily ground-up and value-add attract the broadest institutional LP interest from both family offices and PE funds. Industrial and logistics carry high institutional conviction across both LP types. Data centers are the fastest growing allocation category, primarily driven by PE funds and institutionalized family offices. According to UBS Global Family Office Report 2025, U.S. family office real estate allocations rose from 10% to 18% between 2023 and 2024, with a significant portion directed towards income-producing and value-add strategies. Mixed use with a residential component draws strong family office interest. Life sciences and specialized CRE require more targeted LP matching. What 5 steps should a developer complete before starting institutional LP outreach? Step 1, define your required check size and capital stack structure. A single $25 million anchor check requires a different target than 3 $8 million to $10 million checks from multiple family offices. Step 2, assess your timeline and hold period tolerance, entitlement risk, or construction variability points towards family office. Step 3, evaluate your governance and reporting readiness before outreach, not after. Step 4, match your return profile to LP expectations. Deals underwriting 7 to 12% net fit family offices. Deals reporting 15 to 25% IRR fit PE funds. Step 5, get a warm introduction. Cold outreach to either LP type rarely closes a deal at the institutional level. How do you decide whether to lead with a family office or a PE fund for your next raise? Lead with a family office when your deal is ground up with timeline risk. You need staged capital calls, you want to preserve operational control, and your deal underwrites to 7 to 12% net return to LP. Lead with a PE fund when your raise requires a single anchor check of $30 million or more. Your deal has a clean, defined execution timeline. You can support formal quarterly reporting, and your deal underwrites to 15 to 25% IRR. The most durable capital strategies are built on a clear understanding of which allocator fits which deal, not on one LP type. Hope you enjoyed this video. We'll see you in the next one.